Well, carbon is becoming a priced financial variable, and once it's priced, finance needs to pay attention to that. If your models don't consider carbon pricing yet, there's a real chance you're forecasting the future using yesterday's assumptions. Hello everyone, welcome back to the channel. My name is Diego, and here we're gonna talk everything corporate finance, FP&A, insurance, accounting, and more to the strategic side of finance, actually. And in the last video, we discussed how ESG has officially entered the world of finance. So make sure you're covered with that. Today, we're going deeper into something more concrete, which is carbon markets. So let's do the transition back to the topic, okay? Let's break down how carbon markets actually work and why they directly affect cost structures, valuation, capital allocation, and risk. Because this is no longer theoretical. It felt like, but now, no longer. Carbon is becoming measurable, and once something is measurable, it becomes financial. What is a carbon market? Let's try to summarize this here, okay? At its core, a carbon market is really simple. Really simple. Government set a limit, a cap per se, on how much carbon companies can emit. They issue allowances or permits. You can both ways. It goes both ways. Each permit or allowance represents the right to emit a specific amount of CO2. If a company emits less than its allowances, it can sell the extra permits. If it emits more, it must buy permits from others, so it becomes a secondary market. That's the cap and trade system. There are two main types of markets. First, compliance markets. Sorry. The compliance market is regulated by governments. Participation is mandatory, it's for everyone. And there's the secondary markets, where companies purchase credits to offset emissions, even if not legally required. That's the reality here in Australia currently. But here's the key shift. Carbon now has a market price. And when something has a market price, it becomes a financial input. Why this matters for corporate finance? That's the question. Let's translate this into finance language so that it becomes more digestible. There are three major implications here. First, cost structure. Okay, so if carbon prices increase, operating costs increase as well. Energy-intense sectors, manufacturing, aviation, heavy industry feel this immediately. Margins will compress in this case. And suddenly, FP&A teams must include carbon price assumptions in budget, cycles, forecast, updates, and long-term plans. Okay? Carbon becomes part of your cost base. The second point here is capital allocation. Now, imagine evaluating two projects. Project A is cheaper today, but carbon intensive. And Project B requires cleaner technology but lower emissions. If carbon prices are expected to rise, the cheaper project may become the more expensive one over time. So if finance teams need to integrate carbon scenarios into net present value models, IRR models, investment committees, ignoring carbon pricing can lead to misallocated capital. Asset and transition risk, that's the third topic. As economies transition, some assets lose value. Just how it works. High emission facilities, carbon heavy portfolios, legacy infrastructure, these are often referred to as stranded assets. From a valuation perspective, this really matters. From a from a risk management perspective, it matters even more. Because once markets price transition risk, balance sheets are going to adjust. Balance sheets are really going to adjust, okay? So a real world example here, I'll try to make it practical. Imagine a company with 1 million tons of CO2 per year. That's their allowance. If the carbon price increases from $30 to $80 per ton, that's a 50 million annual cost increase. That's not a sustainability issue anymore. That's an EBITDA issue. That affects free cash flow, that affects valuation. And now think about insurers or reinsurers underwriting carbon-intensive sectors like mining. If regulation tightens or transition risk accelerates, underwriting risk changes. Investment portfolios exposed to fossil-heavy industry may also experience volatility. Finance teams must quantify this exposure. Because once markets move, the impact is immediate, okay? Now, why finance must model carbon? Forward-looking finance teams are already doing this. That's how it works for those companies that are doing this. They running carbon price sensitivity analysis, scenario planning under different regulatory assumptions, transition risk modeling, emission trajectory forecasting. Carbon pricing is not just compliance anymore. Or not only compliance at all, I would say. It's strategic planning, it's risk modeling, it's capital discipline, pretty much. And finance is uniquely positioned to translate environmental exposure into financial impact. That's where the real value lies. Okay? So this is really powerful. If ESG is the umbrella concept, carbon markets are one of the most tangible financial mechanisms underneath it. That's how I would put it. Once carbon is priced, it becomes a variable in your model, okay? And once it's in your model, it influences decisions. So the real question, if you think of it, the real question really is your finance function treating carbon as a reporting topic already, or as a financial driver? If you'd like next to explore ESG reporting frameworks or how to integrate sustainability metrics directly into FP&A models, let me know in the comments down below and we're gonna jump into it. Thank you so much for watching. I appreciate your time and I'll see you in the next one. Thank you.